Hi, I'm Chuck Gibson. This is Taking Stock with Art Jarvis, a bi-weekly discussion of what is happening in the economy, the world of finance, and personal investment with Art Jarvis. Taking Stock with Art Jarvis is a presentation of Loveland Beacon in partnership with Jarvis Global Investments, LLC. Now here is Taking Stock. So welcome everyone to today's edition of Taking Stock with Art Jarvis. And Art Jarvis, thank you again.
Thank you. It's a pleasure to be back.
For sharing your expertise. I want to thank you for that. And I guess, as we were thinking about what's going to happen on today's edition, we were talking about 2 weeks ago where we were. So let's pick up where we left off with the debt ceiling stuff. And what's the rest of that story for everybody?
Sure. There's been all kinds of excitement in the last 2 weeks. We were talking 2 weeks ago. Today is Tuesday, June 13th. So 2 weeks ago from, we were, they had theoretically come up with a debt ceiling deal, and then they were just beginning the process of working it through the House and through the Senate. Well, the good news is it went through, and it went through fairly easily.
Much to our amazement.
Yes, it just flew through the Senate, which I was like, oh, that's fantastic. So, the interesting thing about that is now, I always talk about the markets, and they basically trade on fear and greed, right?
Right.
So it's either it's greed because we want more, or it's fear, we're scared to death, right? And which has basically been where we've been for a good chunk of 3 years, is we've been scared. So we took that piece of uncertainty out of the market here in the last couple of weeks, and the interesting thing is if you look at the S&P 500 index, we were just having all kinds of trouble getting above 4,200. Well, here in the last 2 weeks, we busted through 4,200, and as of today, we're at like 4370 or something like that. So we've had a really nice pop in the markets just because we took that one piece of uncertainty out of the markets. So that's a good thing. And so maybe we're moving on to happier days here.
Well, there is hope. I guess that's the message from that. Okay, we're done with the debt ceiling uncertainty. Mm-hmm. The numbers are climbing again. There seems to be stocks that are performing better once again, a little bit. What are some of the other things that are going on right now? I know you shared some graphs and charts with me. Yeah. Maybe talking about, I was looking at the first one, that the 8 major groups of the consumer price index that you shared with me. What are the things that, people who might be listening, what are some of the key things there that you wanted to share?
Interesting enough, you're right. There's several components to the consumer price index. Housing and apparel, obviously food and beverages and energy, what we're paying for gasoline and things like that. And there's many different ways of looking at the consumer price index. You can just look at it at all items, which is the urban or the standard consumer price index. And the consumer price index is nothing more than a measure of inflation. How much more or less are we paying for goods month over month or year over year?
That's the key word. I mean, you just said inflation. Mm-hmm. That's the key word when you said, we just eliminated that little bit of uncertainty with what's going to happen with the debt ceiling and if the U.S. defaults on its loans or whatever. That's a piece of uncertainty that was eliminated.
Correct.
And so there's a sigh of relief.
A big sigh.
If you will. Right, yeah, a big sigh. But you just touched on another word. Inflation is another key word. And so the consumer price index components that we're talking about here are the things, or that I shouldn't say we, because I wouldn't be the one knowing what we're talking about here. But the things that you're talking about here in the consumer price index, those are indicators of what's happening in the inflation thing. That's a key word today. That's one piece of fear that, I don't want to say it's a piece of fear that remains and that we should be concerned about, but we are.
Yeah. I mean, the Feds are trying to get inflation down to around, they want to be around 2%.
Right.
Right, wrong, or indifferent, that's where they say they want to be. Interesting enough, today, June 13th, the Consumer Price Index came out this morning. And everything came out exactly as they were predicting. But interestingly enough, a year or so ago, we were at 8 or 9% inflation year over year. Well, as of today, we're at 4% inflation. So, and I think we talked about this once before. I'm not as concerned about the number per se. I'm more concerned about the trend. And the nice thing for me as I look at things is the trend has been declining. The inflationary numbers have been trending downward. So that's a good thing. And that alleviates some concerns. That alleviates some fear. The Federal Reserve, the Federal Open Market Committee, FOMC, is meeting today and tomorrow, Tuesday and Wednesday. And they're going to be discussing whether they're going to raise rates again or not raise rates. And the feeling in the markets now is that they're actually going to go on pause and not raise rates again on Wednesday. So,
what does Art Jarvis think? Because I know 2 weeks ago on Taking Stock, we talked about a little bit of a complaint, like when they didn't raise the rates, when they held steady there for a minute, when it's like, hey, you need to raise them now. They didn't. So where, yourself, people don't take this to your bank. This is Art Jarvis' opinion. But what's your opinion? Should they hit pause right now, or is it time to increase the rate again?
No, I think based on everything we're seeing, I would do that pause. Okay. And again, don't get me wrong, I'm not a member of the Federal Reserve, and no one's going to ask me to be. But I mean, I think taking a pause is a good idea. I think everyone was worried about us going into a deep recession, and maybe we do go into one a couple years down the road. But this whole we're going to hit one in 2023 or 2024. I think that's another piece of concern that's been removed. But I mean, the nice thing about them stopping raising interest rates is every time they raise interest rates, it puts more pressure on stocks. So the lower interest rates are, the higher stocks could potentially go because of the market multiple and whatever price to earnings. So here's the price, but then got a certain amount of earnings, right? And actually earnings have been improving also, which is another good thing. So it's interesting to me in the last few months how we've gone from the sky is falling to now all of a sudden maybe things aren't as bad. And even we were talking about some of our leaders, even they have they have a rosier some commentary than they had a few months ago.
A rosier outlook. I'm going to throw something into the mix because I know you shared this with me, and that was just because you touched on the recession thing. Mm-hmm. So that quote from U.S. Treasury Secretary Janet Yellen, "You don't have a recession when U.S. unemployment's at a 53-year low." Which is, that was just, I know you shared that and we kind of snickered about it, but in terms of just sharing that with the people, so that's a good thing.
That's a very good thing.
And that's I guess the question was, when you and I were talking, off the air, so to speak, so she just figured that out?
I was going to try and be kind.
I know. I don't have to be.
Okay. But yeah, it's kind of, stuff like that kind of makes me giggle to myself. It's kind of like, oh, did that thought just come to you? Or, whereas just a few months ago, again, I always say the sky is falling. Right?
Well, again, that's the point of me bringing that into it because of what you shared. That's the message. It doesn't matter whether it's Janet Yellen or somebody else. The message is that's a fear factor you don't need to worry about. Mm-hmm. The unemployment rate has continued to be low, right, at all-time lows, or not all-time lows, but over the last 50 years, it's at lows, and so that fear of a recession shouldn't really be, gripping my neck, right, so to speak. So the message is we shouldn't be sitting here fearing an imminent recession.
And we've been saying that for months. Again, as I said before, I look at the trends, and the trends have been improving. There was nothing, in my opinion, in the economic numbers indicating that we're about to get hit by a major recession. Okay, was there a possibility that we could go into? I mean, the definition of a recession is 2 quarters in a row of declining gross domestic product or the growth in our economy. So if you have 2 months in a row where our economy shrinks, that's a recession. But if our economy shrinks 0.1% one quarter and 0.1% the next quarter, that's a recession. But that doesn't mean,
doom and gloom.
Doom and gloom, exactly.
Right.
So yeah, and you look at gross domestic product or the growth in our economy last quarter was at 1.1%. So are we going gangbusters? No. But are we still in positive territory? Yes. We're at 3.4%, which is the lowest it's been in a very long time. We were at 3.7% just before we smacked into the pandemic.
The percent growth, or
that's the number of people. That's the percentage of people who are unemployed.
Okay,
who
so
are or should be looking for work.
Because that's why I was pulling that out, because you kind of the unemployment rate index from whatever date that. Again, this is June the 13th, and that was the January
around 83
to January. So
yeah. So and the interesting thing, in April or May or whatever of 2020, when they basically just shut down the world, I think we hit officially 14 to 15% unemployment. I would argue the fact, based on jobless claims and things like that. We were getting monthly jobless claims of 2 million, where normal was kind of around 200,000. I would argue we probably had 20% unemployment during that time for a short period of time. So we've gone from at least 14, 15, and I argue 20% unemployment, and here we are all the way back down to 3.4% unemployment. So.
Well, it does feel like, to me, there's been we're still returning to normalcy post COVID, and so that number, 20%. Well, that was if you're shut down, you're the shop owner. You shut down. Now your 5 employees or your 50 employees or your 500 employees are out. So yeah, that number was highly skewed because of the circumstances of a pandemic.
That's right.
But are we all the way back, or is it just the trend is like we're moving back to that low?
I think we're pretty close to back. And you have to look at that number a little bit and wonder how accurate it is. It's been interesting to me here, especially over the last several months, that if you look at jobless claims, they've been missing that by expectations. I think last month they were looking for 190,000 jobless claims, and it was 300 and something thousand jobless claims. So, but still, again, based on looking at the trend is good. Right. So you got inflation coming down, you got unemployment coming down, you still have a positive growth in the economy. Forward earnings projections are improving, but and you take away, if the Federal Reserve is not going to raise rates, you take away that piece of uncertainty, at least temporarily, where you're not putting further pressure on the market multiple. Now, again, there is a such thing as going too far too fast. So
right.
We're sitting here trading at 19 times earnings, forward earnings. So that's not only these earnings right now, but also 6 months forward earnings. So we're already a pretty big number. So I would argue, especially as we're heading into summer here, that we might want to take a breather on that too. But there's always, everything we always talk about is market fundamentals and market numbers and the quantitative part of things. There's also market psychology. Market psychology can take you way, way down into the trough, and market psychology can take you very, very high to the peak, right? So that's, always talk about what's normal, but then you can get 1, 2, 3 standard deviations away from what you think normal is.
You know what scares me? Just throwing the fear thing in again, and it does, and it's really not about the market. But what scares me is that somebody listening might be thinking, "Do this on your own." and making decisions themselves, not using somebody like Art Jarvis, and there's a whole lot of people out there besides yourself. You would say those words yourself. You know, hey, you don't have to call me. There's other people who are qualified.
Sure.
So that's what scares me, is maybe somebody's listening and thinking about making decisions. What do you say about how people should be, and I'm stealing that question, you know, about managing your investments, managing your investment portfolio? What are the things maybe that people should or should not be doing? Start with what somebody should be doing. Probably talking to a qualified advisor, investment advisor, number one. You'd have to say that, right?
Well, yeah, I mean, that'd be great for me.
But no, even, I mean, just not like promoting yourself or others like you,
Yeah.
but the truth is people should probably, you know, for their own safety's sake, for their own financial health and the future, should be working with some sort of qualified financial investment advisor. Yes?
I would say yes, and the reason I say yes is, you know, I'm not saying there are people out there who are perfectly capable of managing their investments. Okay, if they, you know, you're going to get into day trading and stuff like that. I think that's a recipe for disaster, to be honest with you. But some people have done okay with it, but you know, if you're structured about it and you kind of know what you're doing and you're picking good companies and things like that, and stick with it and don't get whipsawed around by all the negativity or all the positivity that's going on at the time, it's doable. But there are also a whole lot of other pieces that a qualified investment advisor should be able to help you with. I mean, the thing, you know, again, always what a football analogy, right? You know, okay, maybe you get 4 yards, but then that investment advisor helps you get that extra yard. Okay, so they help you with your taxes. They help you with, IRAs, and then you get into when you retire, and you know how you take your money and where you should that be in a Roth IRA or a normal IRA. Is that person helping ease the tax burden on taxable portfolios? So you know you can do things where if you have some gains that year, you might be able to go in and take some losses and offset some gains and things like that. So it's someone for you to go and bounce things off of in some ways. Okay, you want some. You know, number one, you want. There's thousands and thousands and thousands of Art Jarvises running around out there, right? But you know, you want someone that you trust. You want someone that you know is going to make what they believe is the best decision for you every single time. I mean, there are things out there where, you know, I can buy this or I can buy that, and you buy that because it has a sales load on it or something like that. That's why, you know, we get paid a fee every year. So there's no benefit. We want to buy. Matter of fact, it's to our benefit.
It's not a sales commission.
Exactly.
You don't want that financial investment guy who is selling. You know, it's like the doctor that goes to the analogy again. I mean, I compare it like the doctor that somebody might call a pill pusher because the pharmaceutical companies like come in and has them convinced. So now you're taking that drug because the doctor and the pharmaceutical company. Yeah. You don't want the financial guy to be giving you the latest financial drug.
Mm-hmm. And here's the funny thing: if you take care of people, they stick around. So if they know that you're taking care of them, you're doing the best that you can for them. I have clients I've had for 25 to 30 years. So it's a lot easier to save a client than it is to go find a new one, right? So
I mean, the people I do business with, I because they're taking care of me.
Yeah.
I really don't want to go look for somebody new, but if you don't take care of me.
Yeah. And it happens every once in a while where it's like, this just isn't working. I'm going to go find a new, whatever it is, car repairman or something. Or insurance guy or something. Yeah. So yeah, I think it's just important to have that person there for you.
We touched on, and I agree 100%. But we touched on this whole the inflationary thing and what the consumer price index components. Did anything stand out? Going back to that for a minute now, and since we still have the chart sitting here in front of us, I mean, does anything stand out on that. I'm looking at a big piece of pie there, which is the housing piece.
Sure.
What's that's a good question right now in the investment world and just the regular everyday world we live in. The housing marketplace. It went crazy.
Yeah.
Has it? What would you say? Not that you're in real estate, but I mean, in terms of the piece of pie, and as part of the consumer price index, where's that fit into the financial picture today for you?
Yeah, I think, I do have a number of friends who are realtors, and of course I'm always picking everybody's brain about how things are going at work and supply chains and things like that.
So that's as simple as what are you hearing?
Yeah, exactly. And what I'm hearing is it has not improved much. There's still a very, very low inventory. Houses are still going for higher than asking price and things like that, and you're
there's still some bidding wars on a home for sale.
Very much so, and I mean it's almost you're trying to get in on houses before they even go up for sale, right? And then you just make an offer and hope it works out. But if you're the seller, why would I do that? If I can put my house on the market and have a bidding war, why wouldn't I? So yeah, that's a big part of the consumer price index, and it's shot through the roof.
Yeah.
The other part of the consumer price index is they'll show you the consumer price index, and then they'll also show you the core consumer. And core would be minus food and energy or gasoline and things like that, because those two are very volatile. So I think today, so we're at, if you look at all items, I think we were at, as I said this morning, 4%. But if you take out the food and the gas, you're at 5.7%. So,
I see.
which kind of makes sense. But so yeah, housing market is still, it's got a way to go. But so do a lot of things. I mean, our supply chains, those are still probably a couple years in the making to get back to something that resembles normal. So that's things companies are having to deal with right now also.
That might be something that we talk about on the next Taking Stock with Art Jarvis. So, because some great questions about what's going on with supply chain, for sure we can talk about that.
Sure.
Any specific message today? Here we are, as you said, June the 13th, as we sit and talk. Could be a later date when people are listening, but bottom line, any specific messages right now for investors looking at their portfolios? Maybe should they be making moves, or should they be just keeping that normal eye on what's happening? And
and as one point I was going to make about why hire a money manager is I spend a lot of my time, especially here recently, kind of well, not a lot of time, but several clients, talking them off the ledge, so to speak. Okay, I want to get out, I'm nervous, I'm scared, and really trying to talk to them and say, there's a reason we came up with this game plan. There's a reason that we came up with these parameters. We need to stick with those, unless we're looking at a financial crisis or a pandemic or something like that. So I guess my message again would be stay with the plan, okay? And my normal caveat, as long as nobody does anything stupid, we're going to be okay, So that's not out of the realm of possibilities if someone does something stupid. But we're the financial crisis was kind of slapping you in the face. It was like, something's not right here. We're way past where we should be. We're doing things in our economy that we shouldn't be doing. We're doing things in the financial system we shouldn't be doing, and we ended up paying the piper because of that. Over from 2008 into 2009, 15 months, I believe, we lost 55% of the value of the S&P 500.
Wow!
Because of the things we were doing wrong. So those are times where you kind of go into protection mode. You do some things different. And again, I'll say it one more time, the nice thing is today is if you do need to go into protection mode, you actually have some alternatives to stocks. Okay. pandemic, again, that was when someone just completely turns off the world. That's a bad thing. Now, again, we pumped $6 or $7 trillion into the market to try and fix that problem. Apparently, it worked, but now here we're doing. Then we went into now we got to deal with inflation. So,
well, one quick note because that pumping the trillions of dollars to fix the pandemic situation, or the results of the pandemic situation financially. Then here comes the debt ceiling thing.
Mm-hmm.
So, what are the key things in that debt ceiling deal that mean, like, apparently we did fix it because, we didn't default on our debt.
Right.
If I got it right, some of that deal was some cutting back on spending.
Right.
So what are the key things for, from what you saw or heard about the deal? What are some of those key things that make it maybe a fix?
Yeah, basically it carried us into January of 2025, right after the election. That was kind of the deal. Let's get this set and let's take it through the election, and then we'll kick the can down the road and worry about it after the election. Well, again, I mentioned we're almost at $32 trillion in debt. Okay. It's a big can we're kicking down the street, and it would literally take decades and decades and decades to fix this problem. And whereas you would go through a number of administrations, you go through a number of government officials and things. So it's a very hard thing to get under control. The problem, so that, don't get me wrong, if you level off government spending and start to drop government spending, in my opinion, that's a good thing. Okay, it helps.
I think we all agree with that.
Well, not everybody, but most people. It's. But here's the problem. So we spend $1.3 billion per day on interest because of our national debt. Now, we were lucky for the last decade because we had lower interest rates, much, much lower interest rates. So our ability to finance our debt was a lot better than now today. We've gone from 0.5% to 5%. Not only is, so they're projecting that 10 years from now, so 2033, instead of paying $1.3 billion per day, we'll be paying $3.9 billion per day. So it's going to triple based on where it is now.
Wow.
Right? Just because of our cost of debt, things like that. So it's a big problem. It really is. And we're going somewhere along the line, there's going to have to be a bipartisan agreement and try and work on this now. We'll see. But yeah, it's. We could have a national debt discussion for 30 minutes also. But
that's a topic for a different taking stock day.
Yeah, I'm trying to think. You look at our national debt. Our national debt is now over 100% of what our yearly gross domestic product is.
To me, that's a problem.
Well, yeah. Try and take that and apply it to your own home. You can't run a home like that, right? No, they're not going to allow you to run your home like that, right? So, where's the breaking point? I think I said this 2 weeks ago.
Right.
I don't know if it's 5 years, 10 years, or 50 years, or 100 years from now. I don't know where the breaking point is, but somewhere along the line, it just you can't. It's not sustainable. That's all there is to it. But again, you asked about the message today. We're still not. Everything I look at, the economic numbers, the earnings numbers, and things like that, in no way, shape, or form do I believe there's any reason to panic. So could we be a little bit ahead of ourselves here over the last couple of weeks? Most certainly. Could we have a slight pullback? Most certainly. That's perfectly normal. But my argument or my suggestion would be stick with the plan.
And that is Taking Stock with Art Jarvis. Art, thank you again for your time
Enjoy
today, and back in 2 weeks.
My pleasure. Thank you very much.
You bet. Thanks for joining us for this edition of Taking Stock with Art Jarvis. Join us again in 2 weeks for our next edition. Taking Stock with Art Jarvis is a presentation of Loveland Beacon in partnership with Jarvis Global Investments, LLC. Jarvis Global Investments, LLC, is a registered investment advisory firm. The advisor is not attempting to furnish personalized investment advice or services during this production. Individuals should fully investigate the appropriateness of any investment before investing. Past performance is no guarantee of future results. Investments may lose value.